This is your LMAX Exchange technical update for Wednesday, February 1st, 2017. Eurodollar. So the euro continues to track within this bullish channel since basing out in early 2017 at 103.41, which also happens to be a fresh 14-year low. The market overall remains confined to a broader downtrend, but this bullish channel correction could still extend higher, with the market now threatening a retest of the critical December peak at 108.75. At this point, there is risk that the market pushes through the top side of this channel and to take out that 108.75 high for an overshoot, resulting in some extended daily studies. At that point, the market could then look for a lower top ahead of a bearish resumption. So it's going to be critical to keep an eye on this market over the coming sessions, but look for any overextended moves beyond 108.75 to be well capped, with the market ultimately not being able to sustain above that level in favor of a bearish resumption. At this point, though, we would really need to see now on a short-term basis a break back below recent support and a close below recent support at 106.21, 106.20 to put the pressure back on the downside. Sterling dollar. So cable has recently stalled out ahead of some critical resistance in the form of its December peak at 127.75. This resistance level is very important because if we take it out, it could suggest that the market has put in a major base, opening the door for continued recovery over the coming weeks and months. However, inability to establish or break above 27.75 will keep the broader pressure on the downside, suggesting that this market could once again roll over for a retest of those recent lows from this year in the 119s, and then that which guard against the more critical support, the plus 30-year low from back in October 2016 at 118.40. Again, there is risk over the coming sessions that we do see a challenge of that 27.75 level, that December peak, but the market's going to need to establish above it to suggest that this market's putting in a more meaningful base. A poke above won't do, and the market will have to establish a close above. So keep an eye at that level over the coming sessions. Right now, the pressure still remains on the downside despite risk potentially over the coming sessions for a little bit more upside. Dollar yen. So dollar yen is seeing a critical break now. The market has taken out some recent support in the 1250 area, and after consolidating roughly between 112.50 and some resistance up around the 115.50 area, this opens the door, now that we've broken down below 12.50, for a potential downside extension, a measured move objective equal to that recent consolidation of about 300 points, taking us down into the 109.50 area. So there is risk that dollar yen, despite being in a broader constructive uptrend, the market could still see one more drop back towards the 109.50 area before potentially or probably finding some support in favor of that next major higher low and bullish continuation ultimately back above 118.67 and through 120. Euro Swiss. So Euro Swiss saw a really nice bounce on Tuesday, but this market continues to be very well capped into rallies, and it would be hard to see this market not retesting that 2016 low at 106.24, potentially opening the door for a more significant decline below that level. Again, if we establish a close below 106.24, taking us down towards psychological barriers at 105. At this point, this recovery would need to extend and establish back above 107.60 to take the immediate pressure off the downside. Aussie dollar. So Aussie has seen a very nice rally in 2017, but the market is now starting to show signs of running into resistance up above 76. There is risk that this market could continue higher, just like with the euro and the pound. We could see this Aussie market also want to continue a little bit higher up towards the 77 area, but once we get up into the 77s towards 78, there's a lot of medium-term resistance up there, and the market should ultimately stall out in favor of a more meaningful bearish reversal, potentially taking us all the way back down to medium-term support going back to 2016 in May around 71.45. Dollar CAD. So dollar CAD saw a major breakdown in Tuesday trade, with the market taking out that critical psychological barrier at 130, but the market was able to hold above that level. It's going to be interesting to see how the market responds to 130 over the coming sessions. If it starts to try and establish below on a close basis, again, there is risk over the coming sessions for dollar weakness, and this breakdown does open the door for some more setbacks in dollar CAD, but ultimately, again, it'll be interesting to see how this market responds around the 130 area over the coming days. On Tuesday, we did see a low all the way down towards 129.69. Next medium-term support for this market comes in at around 127.65, going back to August of 2016. So the market has broken through a barrier. The pressure is on the downside, but overall, this is still a constructive chart while it roughly holds above 130. Of course, on a short-term basis, we need to see this market back above 31.70 to put the pressure back on the top side. Kiwi dollar. So Kiwi continues to extend its run in 2017. This market has been very aggressive to the top side, breaking back above 73, and most recently, again, still, and despite this latest run, the market continues to show signs of a major top off that 2016 high after stalling shy of 75. And so it does appear that this run, at least on a short-term basis, should start to stall out around current levels in favor of a bearish decline. So if we do see over the coming sessions a little bit more upside through 74, it should stall out somewhere in that area in favor of a bearish decline. Right now, on a short-term basis, we need to see a break back below support around 72.20 to get this thing going back to the downside. SPX 500. The S&P 500 has seen a nice pullback off its recent record high from the previous week, just over 2,300. The market has been extended over the past several years, and so there is signs of the market needing to put in some form of a major top. But at this point, even on a short-term basis, we need to see a breakback below 2232. That's the low from December of 2016, the last trading day in 2016, to get this thing going to the downside or to suggest a top. Until then, we can't even have that conversation, and the overall pressure remains on the top side with risk for a pushback above 2300 and towards the next measured move extension area in the 2320 to 2340 area. Gold. So gold is a market that is now very well supported on dips, showing signs of a major base in 2016 after being well supported ahead of 1100 in the 1120 area. And so this latest push that we saw back above 1200 was very constructive, confirming the possibility for this major base. And although we did see a pullback in recent trade back below 1200, it was very well supported into that dip around 1180. And it looks like the market wants to put in a higher low there ahead of the next major upside extension through recent resistance at around the 1220 area, which would suggest a $40 move to the upside once broken, a measured move up towards the 1260 area as that next measured move extension over the coming sessions. At this point, of course, a break back below 1180 would delay that constructive outlook, but it certainly wouldn't negate it. Ultimately, we would need to see a break below 1120 to really negate the basing outlook for the gold market.